Good afternoon, everyone. Welcome to the Daily Rundown video. This is Mike. Today is Friday, June 11th. Let's talk about the story that we have for you today. Yesterday I told you a story in which I broke down the hot inflation report, explained to you why I think inflation we're seeing right now is transitory, and why the Federal Reserve will not raise interest rates. What I did not focus so much was the market's reactions and what actions we're taking with our portfolio. Here are two reactions that happened yesterday and they follow through today. We were able to pick them out. The inflation-friendly trade on one side, so stocks that benefit from inflation and potentially higher interest rates, they all have pulled back drastically. On the other hand, you have growth stocks, or stocks that trade based on future earnings, which would get eaten away if inflation would be a problem, and if interest rates are higher, the valuation of the company would get hurt. This group has been on a tear. So if you compare two companies, just pick two companies from two sides. I picked Citigroup. It's a bank, down 2% since Thursday, while Microsoft up 2% since Thursday. So what I think we're seeing is a rotation back to growth. There are two main reasons why I think this is playing out now. But first, let's take a step back into earlier this year and recall what happened. Earlier this year, we got very fast economic recovery, big economy reopening, boom of activities, big price increases. All of them point to the potential that at some point later this year or earlier next year, the Federal Reserve will have to taper bond purchasing and raise interest rates to control inflation. On the backdrop of that sentiment, growth stocks took a big hit because growth stocks by nature trade based on future earnings, which would be eaten away if inflation is high, meaning what the company makes today won't be worth as much in the future. So at the beginning of this year, you have what was referred to as the great rotation from growth into value. Now here are the two main reasons why I think we'll begin a rotation back into growth. First, the reflation trade got too crowded and have outperformed this year. If you look at the charts of cyclical stocks, bank stocks, industrials, or just generally stocks that would benefit from inflation and higher interest rates, you'll see that they have moved up huge. Compare them to growth stocks, companies like AMD or Microsoft, Apple, software companies such as Salesforce, and especially Amazon. They have done practically nothing. So you have investors who have gained big in the former group. They're now looking to rotate into the latter group. Second, people are talking about peak economic growth. In other words, people think that we've reached the peak of the economic boom here, and cyclical trades are no longer at the peak of their economic cycles anymore. This is something that gets people confused. If we're at peak economic growth, why would we rotate away from cyclicals and rotate into growth stocks? Well, stocks are called cyclicals because they follow the economic cycle. The company does well when the economy is booming, but would not do well when the economy is slowing down. Growth stocks that are secular in nature do not particularly care about the economic cycle. They have an underlying strength that is secular, that would grow stably regardless of where we are in an economic cycle. People think that we're at the peak of the economy, meaning that the economy won't get any better, not necessarily saying that the economy will get worse. But when this happens, it makes sense to rotate into the secular growth stocks because simply there's nothing left in the cyclical trades. So now you understand what's happening in the market. It seems like we have a rotation back from value into growth. Now let's discuss how we're positioning our portfolio to participate in this rotation. First of all, and very importantly, this is what we are not going to do. We're not going to sell all of our value, our anti-inflation or cyclical stocks and buy growth. We're not going to do that because we don't know if we're truly out of the woods yet with inflation. Plus, we don't know if we've reached economic growth. We don't know if the Federal Reserve will raise interest rates, if and when. All right. So right now, the stock market is pricing as if inflation is not going to be a problem, and we have reached peak economic growth. The best approach for us is to have a barbell approach, meaning you try to keep a balance between value and growth. And depending on where we are in the economy, we may have a sector to be overweight compared to the other sector. And in fact, because we've been keeping a barbell approach for the past week, as the rotation happens, we're not hurt as much, because while banks lost some value, materials trade lost some value, our growth stocks outperformed companies such as NIO or Apple, Microsoft. All of the growth stocks that we keep on our portfolio, they are starting to perform again. So that's the benefit of having a balanced approach to the market. Now let's talk actions. Here are some actions we took today and yesterday. All of them are posted in the portfolio actions section of our website. So first, we've trimmed some Bank of America stocks. We reduced its weight because Bank of America is an especially rate sensitive stock. So when the prospect of higher interest rates, that prospect is dimming, the bull thesis for Bank of America in our portfolio weakens, so we have to kind of adjust our portfolio accordingly. We've used the cash that we raised from selling Bank of America and put some of that into PayPal. PayPal is a growth stock, and it looks to us like it's ready for the next leg up, participating with other growth stocks. You can read more about PayPal investment thesis in our stock picks tab. And lastly, there's another name that I really want to add to our portfolio. Going back and forth with my group, just trying to figure out if we can work it into here. And that stock is AMD. This is a great secular growth stock. They reported earnings back in May. Revenue was up 90% year over year, and earnings per share was, we believe, was tripled. So that spectacular growth there. But the shares of AMD have done nothing for the past year, and we know why. It's because of the Xilinx deal. So when the Xilinx deal closes, which we believe will happen within the later part of 2021, when that actually happens, we believe AMD should be heading to $100 once that deal closes. So we'll probably look to add this stock to our portfolio sometime next week, and you'll be the first to hear it. So all right, that's it. We'll wrap up our first week being live on the web. I hope it has been beneficial for you. Hopefully you found great value in following the actions that we take and listening to our analysis. We hope you have a good weekend, and I'll see you on Monday.